In this section, we shall explore key financial ratios and how they apply during business operations. Key financial ratios are metrics derived from financial statements that help SMEs evaluate their profitability, liquidity, efficiency, and solvency. For SMEs in Uganda's oil and gas sector, these ratios are essential for decision making, cost control, and growth planning. Let's look at the profitability ratios first. There are three ratios to explore. First of all is the gross profit margin. This measures production efficiency and profitability before operating expenses. It is calculated by dividing the gross profit by the revenue times 100. Secondly is the net profit margin. This profit margin measures overall profitability after all expenses. It is calculated by dividing the net profit by the revenue times 100. Third is the return on assets. This ratio shows how efficiently assets generate profit. It's calculating by dividing the total assets by the net profit times 100. Secondly, we shall examine the liquidity ratios. These are current ratio and the quick ratio. The current ratio assesses short-term ability to meet obligations, while the quick ratio measures liquidity without relying on inventory. The current ratio is calculated by dividing the current liabilities by the current assets, while the quick ratio or the acid test is calculated by subtracting inventory from current assets, then dividing by the current liabilities. Lastly are the solvency or leverage ratios. We have the debt to equity ratio, which is calculated by dividing owner's equity by total liabilities. This indicates financial leverage and risk. Secondly, the interest coverage ratio, which shows the ability to pay interest on debt. We also have the inventory turnover, which measures how quickly inventory is sold and replenished. We also have the receivables turnover, which measures how efficiently the business collects payments.